All right, hello everyone. Welcome to your weekly market check-in here with myself, Greta Wall. I'm your host, and I'm joined by Derrick Oldensmith, the head trader at T3 Trading Group and leader of T3 Live's Pro Desk virtual trading floor. Before we get into any market-related discussions here, just a quick disclosure of Derrick's current positions as of our recording here today on May 4th, 2026. The title of our stream today, Derrick, being oil spikes and it's jobs week. So there's a lot going on. The market, though, currently as we speak, is focused on the conflict in Iran as it continues to drag on, and what's happening there with the Strait of Hormuz, passage of oil, other goods, etc. Oil prices, as we speak here, up over Brent futures up over 5%. And WTI crude oil up over 3%, Brent at $114 a barrel. So when it comes to the market reaction to what's happening in the oil market and with the Iran conflict, what's your read on that situation?
Sure. So oil has been grinding its way up for the last 2 weeks or so now, back to post conflict highs and eventually through those post-conflict highs. And the market has managed to completely ignore it. We made new all-time highs on Friday for the indices across the board. At a certain point, does it matter? Yeah, it will matter. But I think that the Iran situation with what it's doing to the price of oil, assuming that this stays bad, it creates winners and losers. And that's what you have to remember. 40% of EPS growth is from CapEx spending. And when you think about the companies that are doing that CapEx spending, which is primarily Mag 7 companies, they're so insulated from Iran and the oil spike. I keep using Meta as an example, right? So Meta being one of the big CapEx spenders, they are just bringing in all this revenue from their advertising business, which is a cash flow machine, and they're spending it on AI CapEx because they think that that's the future. How does the higher price of oil impact Meta's CapEx spend? It doesn't. It's so far removed. You would need the economy to slow down so dramatically that the advertisers stop spending on advertising, and then Meta's revenue begins to fall. And then as a tertiary effect of that, they begin to reduce their CapEx spending. So the impact that this is going to have on Mag 7, on semiconductors, on the Qs, on tech is very limited. The concern that I have a little bit more is on IWM related stocks, the mid caps and the small caps, mainly because those companies are much more subject to using debt for their ongoing business because they're not the same cash flow machines that a Meta is. And the problem with the move higher in oil is that it can cause interest rates to spike because it creates inflation. So for good reason, when we look at inflation numbers, we take out volatile food and energy. You hear that all the time, right? So the Fed, they're not supposed to be making their decisions based on what the price of oil is actually doing in any given moment. And again, that makes sense. Like to what degree can the Federal Reserve control the Strait of Hormuz by raising or lowering interest rates? They can't. The concern is more that, per Jerome Powell just last week, core inflation is ticked back up to 3.2%. So it's taking out oil. And while we do take out oil, there are secondary impacts into the core inflation numbers that come from higher oil prices. For example, higher airline ticket prices. If the price of oil is higher, then airline tickets are going to be higher, and that actually is an inflation metric that we're paying attention to. So what you're beginning to see, less so in the US, though it's happening here as well, and we had those 3 dissenters just last Wednesday who were dissenting against being more dovish, basically. But what you're beginning to see is kind of a global tightening impact. And global tightening will have ramifications on the stock market. It tends to reduce market multiples, but it should particularly negatively impact the IWM. So I have been calling for and kind of liking a bit of a pairs trade where you're short the IWM while being long the Qs to take advantage of the fact that, well, everything I just discussed, that big tech is so insulated, and the IWM is where the weakness will be if this war continues to drag on, which that's what it's looking like right now.
Amid all of this that's happening for the market, as you mentioned, the Mag 7 companies and their earnings. We are in the heart of earnings season. Arguably the busiest week was last week with Meta, Microsoft, Amazon, Apple, Google, SanDisk, like all of the important names reported pretty much last week, besides NVIDIA and the few to come. This week, though, there are some important reports. We're going to get Palantir after the close today, AMD after the close on Tuesday, and then ARM and App 11 on Wednesday, being some of the highlights for the market this week. Of course, other reports as well. So when post Mag 7 week last week and heading into this week with earnings, what's your take on earnings season so far and the reaction to those reports that we've seen?
Earnings season's been phenomenal so far. The companies that reported last week overall were excellent. I mean, even if you pick the worst one, which is Meta, it was still excellent. It's just that people are concerned that they're overspending on CapEx, which they are, and as you and I have discussed, at least in my opinion, they're kind of losing the AI battle compared to some of these other companies, yet they're continuing to spend more and more and more. But still, the numbers were phenomenal. And if they ever pull back on their CapEx spending, well, you'll see the semiconductors go down, but you'll see Meta go higher. The Google report was phenomenal. It was really, really good. The Amazon report was really good. The Microsoft report was pretty good as well. Azure could be a little bit better, but overall fantastic. And then to round things up, you had Apple on Thursday, and Apple, in addition to having a really good earnings report, announced a $100 billion buyback. $100 billion. I mean, that number is astronomical. That's on their buyback alone. They're going to be on their own bid, and they're not going anywhere. So all those reports just further in my mind so that we want to be buying dips and Qs, buying bull flags and Qs, still not chasing extension. And at highs today, before we just rolled down a little bit, we were starting to get back towards extreme upside extension in the NASDAQ. I never want to chase price, but I think that this bull market has legs, especially on the tech side of things, and I want to buy flags and I want to buy dips. It's a game plan right now.
The report after the close today, the biggest report after the close today is Palantir. You and I have talked about Palantir a lot in the past. At one point, it was the most, people would say, one of the most overvalued stocks in the market, and then did get hit with the software slump. Software stocks, though, are coming back a bit, and so Palantir also coming back a bit. Stock is up almost 2% today, headed into that report, hit a high earlier in the session and has pulled back since then. So what's your take on Palantir pre-earnings, and then any plans for maybe a post-earnings play?
Sure. So software in general, we called for a long on Friday. We're getting a little bit of follow through, and it's a good trading vehicle. The IGV is a great software ETF that we look at a lot. I think that big picture software is going to kind of be a little bit of dead money. It's not where I really want to be focused, but smaller picture, it will present great trading opportunities. And IGV on Friday through today has been one of those opportunities, and there's been good relative strength in software in general today. Palantir specifically, which is one of the largest components of the IGV, is still, in my opinion, dramatically overvalued at these prices. It's still a really, really expensive stock, even having pulled back from what was that high? Over 200, like 205 back down to 150. So I currently do not have a Palantir position. I don't necessarily have a plan to trade it after hours either, but we'll see how it goes. I didn't have a plan to trade Apple after hours. As a matter of fact, I had plans that day after the market closed, and I told everybody in the afternoon meeting, I was like, hey, I'm going to do the afternoon meeting, and then I got to go because I got some plans. I'm not planning on trading Apple today. And then the second I heard the $100 billion buyback announcement, I found my finger just pressing that buy button pretty much instantly, and it turned into a pretty good trade. So when it comes to Palantir, we'll see how it goes. We'll see what the numbers look like. We'll see what the reaction to the numbers is. and then decide on whether or not I want to trade it. But for the moment, I'm not currently planning on doing so. I think $150 is a little bit of an important level. And then if it can really get back above like 156 to 160, the chart will actually start looking pretty good. Not predicting that that'll happen. If anything, I would guess that the opposite is the move, but it's a pure guess. However, if it were to get above those levels, then there's a potential long trade there for continuation.
All right. Besides earnings this week, there are some other catalysts, that being some economic data. It is, like I mentioned at the top, it is jobs week. So we'll be getting a slew of new jobs numbers released by the government and also the private sector this week. The ADP private sector employment numbers come out Wednesday morning pre-market, and then the official non-farm payrolls from the Labor Department is on Friday before the market open. How are you feeling about this jobs week and the importance of it at this report?
So
it's Fed meeting last week.
It's going to be really important, especially in the context of, once again, inflation rising.
Right.
Because if you get a bad jobs number here, then we're starting to look at the potential of stagflation again, and we do not want stagflation. That'd be the worst thing that could happen, because it's very, very hard for the Fed or anyone to be able to fight stagflation, because dueling mandates there have opposite impacts based on what you do. So yeah, given where inflation is, we really need this jobs number to not be a disaster. But I don't have a crystal ball. I don't know what it's going to look like, and we'll see soon enough.
All right. Just for everyone, the expected numbers are 53,000 jobs added last month. That would be a drop from the 178,000 that were added in March. That was a big surprise to the upside. And we'll also see one really important part of the jobs reports is the revisions, the backward revisions to the previous month. So does that number from March hold? Does it get bigger? Does it get smaller? Those are important things to look at as well, not just the headline number. All right, we are in a new month of trading. May officially started on Friday, and April ended on Thursday. So when you think back on April trading, how would you grade the month and how your own performance, but also just the market performance, and how good of a trading environment was it for you and your style? And then what are your expectations for May?
Sure. So April was a very, very unusual month. The market move that we had was unprecedented. It was the fastest up move in the history of the stock market, not coming out of a recession. Extremely, extremely fast. So for me, it was a little bit of a mixed bag, because at the very end of March and into the beginning of April, I was extremely bullish. When no one else was, by the way, at the end of March, and we were downtrending, we were looking technically not good. And I was saying, you got to buy this dip. We got to buy the downside extension that the market is presenting to us, because if we can break higher, then buyers are going to be found higher. And sure enough, we got the ceasefire as I predicted. We gapped up huge, and those buyers were found higher for the continuation. So on the long side, again, that move was so hard and so fast. I did a really good job with it. I had positions from March lows, some of which I'm still in, and just caught the entirety of the move. What made it really tricky, though, also was, as bullish as I was, and I really was and still am to some degree very bullish. I was extremely bullish back then. The speed of the move actually made it difficult, because it's just not how markets typically work. And the way that I trade really takes technical extension into account. And that move higher was the most technically extended that I've ever seen the market for the most prolonged period of time. So I found myself maintaining those longs, which were paying me, but also putting shorts on based on extension rules that I was rapidly losing money in, just because of how unprecedented the move was. And I ended up taking some losses in some of those shorts that I was putting on, again, because of that extension. Luckily, again, cushioned a little bit by some of the longs I had on. But it was a learning experience, because I was having a couple meetings with my team about this. The market has really changed. This is a very different market than I have traded for most of my career. As a perfect example, I used to always teach, because it was true, that V bottoms are the rarest type of bottom that you can get. Now the V bottom, big picture, is the norm. March's low was a V bottom. A year ago on the tariff tantrum, it was a V bottom. COVID was a V bottom. It seems like V bottoms are becoming the norm. So that is one example of just how this market has changed. Another is the degree of dispersion that the market shows us, where we have all these days where the S&P trades flat. But I mean, there's one day, I think it was the day after, I think it was Thursday last week, where NVIDIA, which is the largest market cap company, was down 4%, and Meta was down 10% on earnings, and Microsoft was down a few percent, and Amazon was like flat or flat red. Sure, Google was up 10%, but the market still had a huge day. So baffling that NVIDIA, as big as it is, could be down 4%, NVIDIA alone, let alone the other ones, and the market could be up as much as it was. But that is what dispersion does, right? So if you're going to have a weak day in NVIDIA, then the other semiconductors are going to be higher. If the other semiconductors are going to be down, then NVIDIA is going to be higher. That is a more pronounced, unique thing of the modern market. And then the final thing just continues to be, and I've been talking about this with you, Greta, for years now, but it's becoming more important, which is just understanding positioning, flow, market dynamics, and what the systematic strategies are doing. Because in hindsight, with the loss that I took on some of my shorts, where I was shorting that extreme extension in April on the way up just because of how fast we went up, I was fighting a massive systematic bid. And I knew that systematic bid was going to be there. So what I tell the traders all the time is don't fight the flow. We have the data. We have the information in front of us. We know when the systematic strategies, generally speaking, are going to be buying or selling, and when they're going to be doing it at extreme levels. And on the one hand, my extension rules for counter trend trading have been really successful for me overall over the course of the last 6 years. But the instances in which they're not is when I'm fighting that systematic bid, because the systematic strategies, the algorithms, they do not care about war or oil or who the president is or what day of the week it is or what month of the year it is. It doesn't care about any of that stuff. They're just going to buy and sell based on the rules around those strategies. And we're able to see the models that tell us what they're going to do. So don't fight the flow is the relearned lesson. And one adjustment that I'm going to be making to my trading going forward is I'm still going to use those concepts of extension because of how much success I've had with them. But I really need to make sure that I'm using that in conjunction with the systematic flow. And one of the things I always talk about in trading is this concept of layers of probability. What are all of the influencing factors that are going to impact the market? Well, if the extreme extension says that I should be going short and not buying, but the systematics say the opposite, well, I've got two competing pieces of probability there, and I therefore need to recognize that I don't have the same probability of success because, well, there are two opposing factors there in the trade that I'm looking at. So yeah, I think that kind of covers it.
All right. Derrick is a real trader. As I mentioned again at the top, he is the head trader at T3 Trading Group. If you have any interest in working with Derrick himself and the team over there, you can go to t3live.com/DOLive. Again, fill out that form there and someone will get back to you. Derrick is, again, the head trader there at T3 Trading Group. Every trader who works with the firm works directly with Derrick in his ProDesk virtual trading floor on a daily, every trading day with the market is open. So again, Derrick, have a great rest of your day, good week, and we'll talk next week.
Thanks, Greta. Talk to you soon.